What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is March 11th of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, we're not only going to be diving into cryptocurrency markets and talking about the continued strength we're seeing in our key altcoin plays, but along with that as well, taking a look at the broader traditional markets and talking about the continued growth and fear, even after tons of different new policies and forms of stimulus in order to try to stimulate the economy to combat the growth of recent concerns. So we've got a lot of things to discuss right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DATADASH. Alrighty, everyone, so let's go ahead and take a quick look across the board on cryptocurrency markets, because we will be focusing more on traditional markets throughout today's video. As we can see across the board for cryptocurrencies, most are in a no-trend scenario still since we last talked. Nothing too severe in the red, but a few key players up in the green here. And we can see that they're plays that we're familiar with. For example, Basic Attention Token up 6.5%, Steem up 5.5%, Kyber Network up nearly 9% over the last 24 hours, and Ren as well, another one of our plays for the year, up over nearly 16 to 17%. So really good to see this, and again, see a good amount of plays across the board doing well with some good volume. But the major thing here, again, guys, to emphasize is that we're seeing a good trend here, not only in Bitcoin holding into its logarithmic wedge here, but along with that, we're stepping up to the halving soon, and we're seeing that a lot of our plays, even in an environment where Bitcoin dominance is still relatively flat here, where we'll take it here to the daily, we haven't seen too much change since back here in late February. We're still seeing a lot of gains here for some of our plays, so it signals to us that we're in the right positions, at least for right now, right? We can see Ren, for example, continuing to tower higher as Bitcoin has been relatively stagnant at the moment. Kyber Network as well, blasting past its previous resistance point in the past, and now looking like it wants more in this case. And the cool thing about Kyber Network, as we've been talking about for a while, so once we break this wedge and once we break past this general resistance range, there really isn't too many big resistance marks for Kyber Network. And the valuation, again, for the proposition that it's offering, I think is extremely much more on the lower side versus being overinflated and things of that sort. So again, this is what I'm watching for. Again, Basic Attention Token, again, it's been holding this level for a while. Looks like it's finally ready to make a move of some sort. So we've been doing well, guys. We've been positioned in these plays that are big leaders, big game changers in the space, and again, are both not only focused on the sense of fundamentals, but also focused on good TA, good price action, and just overall a good narrative in the sense of these projects. Ones that are really leaving change in the space. And again, as I've talked about extensively when it comes to altcoin markets, we're going to see a much more smaller group of players really succeed in this run-up, and I think we're going to get a lot of good multiples in the space, ones that really multiply their valuations time and time again, over and over. But at the end of the day, you have to be able to spot those key players that are really getting user adoption, really developing fundamentals, and actually building real demand on the market. So again, these are the plays that I'm looking at. We've also got Link as well and a few other players. Link is down about 1%, but still holding relatively strong here if you take a look at the weekly or even the daily, depending on what you want to look at, right? It's holding up relatively close to its previous highs. So again, general portfolio is looking nice, guys. I'm liking it, and I want to see this continue to develop no matter where Bitcoin's pointing at the moment, right? Outside of that as well, you guys know it's been capturing global markets here. This is really the main topic I want to discuss about today. So we can see, again, with what's been going on, there's been continued fear around the topic, and with this, I think the best place to look at, really, if we want to understand the severity for the economy, is to take a look at global markets in this case and see what markets are, interpreting from all of these numbers. Now, I do like to see here that, again, the numbers haven't gone too exponential here, and along with that as well, we're still getting a decent amount of recovered individuals, but at the same time, markets don't seem to be taking a liking to it. Right now, if you take a look across global markets from yesterday, we had a pretty nice global rebound across the board. Most indices were ticking up yesterday. It doesn't matter if you're looking at the United States, Europe, Asia, different regions of the world and stuff. It's such as South America that have been hit pretty hard, such as Brazil. It doesn't matter. We saw a pretty good rebound yesterday. But now it seems like we're fading off most of those gains. And the concerning thing for me is that over the last 24 or 48 hours, not only have governments reassured that they've had this under control across the board. I think the major thing that we want to do, with most governments in this case, is they want to make sure people keep calm and they do the proper things, such as washing your hands and all kinds of stuff like that. But along with that as well, the major thing that a lot of these governments are doing are to guarantee that there's going to be enough economic stimulus, enough policy decisions that maintain the current state of the economy, that maintain the relative strength that we have across the board in global markets right now that have led equities as high as they've gone, and then also the kind of job security that we have right now. Again, it's not great. I think we understand, guys. We've complained about it in the past. The world economy has not been working for what you would call probably the middle class or like the average everyday person for a while. But at the end of the day, right, they want to keep the current system going because it could get far worse if things don't get, implemented soon enough, right? If we don't have enough procedures in order to combat the slowdown in global trade, global economic activity, the global consumer, and in regards to the economy right now, due to a lot of the growing fears, right? Well, if we take a look here at global markets, we can see across the board all of these policy decisions, which we'll dive into in a moment, and all of the stimulus that they've tried to provide are not doing enough, at least according to the market. We can take a look here, for example, the S&P 500. We got a nice little rebound yesterday. A lot of the gains faded off already, and then now at the open here of our futures, we're tailing down nearly 3%. So it's becoming common practice now that we're seeing, upward days of 1 or 2%, maybe sometimes 3%, and then also days where we're going down 3 to 5% yet again. And we're just rolling over on each day where we're getting gains here. This is the sign here that we've not only got more downward price action, but along with that whatever we're doing is not enough, okay? Along with that as well, take a look at the Euro Stoxx 50, again, a broad index of European stocks, from 3,800 points down to 2,900 points. Futures are reading down about 1.66%. So it looks like now, for example, I want to jump back here just to the S&P 500. Take a look at the long-term time frame and tell me confidently what you feel about this price action here. Does this give you an indication that we're still set for new all-time highs, that markets are going to keep chugging forward, and that we still have yet to go before we've set a top in this market cycle? Really, just take a look at the chart here, right? Again, at these kind of expanding tops here where we're getting bigger and bigger corrections. And again, you might agree or disagree with me on this, guys. I really think that this is showing a pretty clear top here. Again, we'll have to see. It isn't even as severe as the previous correction, so we've still got a ways to go if that's the case. Along with that as well, in the Euro stocks, take a look at the max chart here. We previously topped out here at a high range of around 3,800, as well as over here. Tell me, do you guys see a lower double top here from the previous all-time highs back in 2007? That's what I'm seeing. And I'm seeing a pickup in volume here as well, where we've had pretty relative stagnant volume here on the Euro stocks. Along with that as well, the Nikkei for Japan, down 2.3% on the futures right now. Take a look here again in the short term, right? We're testing towards this very important range that we saw back here in December 2018, like we saw on the Euro stocks. Take a look at the max chart, right? Setting lower highs for the last couple of years. Does this seem like it's in a good position when it's testing towards a support range that after that pretty much is going to be all the way down here to 14,000 if anything? To me, it looks like we're setting a market top, right? None of these charts look good to me, guys. And that's not me being biased. I don't want the stock market to crash. Screw that. I don't care about just getting an opportunity for me to invest, right? This is people's hard-earned retirement portfolios. Again, there's a lot of things at stake here, right? I'm just saying I'm not going to be biased. I'm not going to try to, fit this one way or the other to fit my narrative. This just doesn't look good, right? These are the kind of signs of a market top. If I saw this in crypto, I would be thinking the exact same thing, that this is probably entering into a bearish pattern after one of the longest economic cycles in history. Take a look at Israel as well, right? The TA-35 for Tel Aviv. We've gone down from 1751 down to 1368. Again, testing towards that key support range back from December of 2018. Take a look at the max chart here. Clear double top, right? After a very long cycle going down from here around 200 points on the indice, all the way up here to nearly 1700 in this case. Now tell me, could you confidently enter into a position when we just broke past a key level of support for Israel from all the way back in 2014? I know I couldn't, right? This is the reason why I look at foreign indices, guys, and why I'm talking about traditional markets is for two reasons. To the second point, traditional markets are extremely relevant. Understanding what's going on in the major global markets, these multi-trillion-dollar equity markets, is extremely important because you're talking about tens, if not hundreds of trillions of dollars of valuation that are getting wiped off the board overnight. And the thing is, we can't just focus on U.S. markets because the entire economy right now, in an age of globalism, we're so interconnected, right? So if the dominoes start to fall here for countries, for example, like Israel, which have completely set the highest standards here in this case, in the sense of quarantining individuals who are coming through the country. They have a mandatory quarantine for anyone coming into Israel. To see their markets selling off overnight here, 6.5%, that's not a good sign. That to me is dramatically concerning. Now, I want to go ahead here, right? Take a look at the RTSI here, right? We can see here, out of all countries, Russia is trading down nearly 13%. Now, we know that Russia has gotten caught in, obviously, just like every other country, in the mix of what's been causing a lot of global fear, what's been spreading as a recent. But along with that, they've also gotten caught in a war with Saudi Arabia over oil production. And again, as we know, Saudi Arabia, as well as a lot of the OPEC nations, have come to the conclusion that they're going to keep producing at lower and lower prices. And this is obviously knocking Russia back down to the same territory that a lot of major indices are down to. But take a look at the max chart here, guys. A third lower significant high here. It may not be good to have all of your economy focused on producing commodities, but nonetheless, again, all in all, guys, this is very severe here, right? Now, the key thing I want to drill in here, right? It'd be one thing if all these equities were dropping. It's another thing when you factor in all of the steps that we've seen from, say, the United States, for example, which we're going to be taking a look at, to all the other nations across the world to stimulate markets. You have, for example, Italy, which is basically writing off people having to pay their mortgage. You're having, for example, China at least having a swift reaction to what's been going across the world globally, and they were able to contain it quite nicely, at least from the official numbers that we're getting. But in the United States, for example, right, we have to take a look at the policy decisions that are being implemented here. Now, I'm actually not here to really per se criticize them at all. For example, in the recent political administration, we actually had Trump, for example, come out with the idea of a 0% payroll tax, basically providing massive tax relief for the consumer in order to stimulate economic growth. And there's even talks as well about potential kind of short-term bailouts for example, the travel industry, the airline industry, as there have been not only multi-$100 million, but if not billion-dollar hits on these major companies that could send many of them into potential bankruptcy. So on these policy decisions, again, we can debate whether or not these are good or bad. I really don't think a payroll tax cut is really that bad. I like tax cuts for average everyday people as much as the next guy. And in the sense of these bailouts, these are a bit different, I would say, than bailing out the banks, which were doing something they knew was wrong, right? And they eventually just got away with it and were told, don't do it again. And we know most likely in many cases, even though there are new regulations, things of that sort, it's just a different picture, right? It's something that this is a natural phenomena that these companies didn't really kind of proliferate, right? So I could see maybe some arguments there. It's a little bit different. But at the end of the day, again, all of this came out yesterday. And it did lead markets growing a little bit higher here in the short term. And then after that, a lot of the gains faded. And we're seeing that in futures markets right now. So after promising a tax cut that could bring in hundreds of billions of dollars to the deficit to supplement economic growth, and billions of dollars for potential bailouts to these hard-hit industries, alongside a prediction that the Fed, by this month, is going to be dropping interest rates. Most likely 90% of the betting market believes under the CME group that we're going to 25 to 50%. So we're basically going to have a 50 or 75 basis point interest rate cut after an already 100 point basis cut, or 1%. They're expecting, not to mention as well, in April that we're going down most likely somewhere between the current target and 0 and 25%. And if you take that to July, again, that confidence range between June and July is holding at the exact same range. And this is, again, already after the Fed has stacked up over $500 billion in additional assets on its balance sheet. It's already provided additional stimulus and the underlying plumbing of the repo market. And China has been following suit as well, as it had to deal with this crisis itself. And again, even with record amounts of stock buybacks, we still can't seem to keep stocks up. This is what concerns me, guys. All of the tools have been nearly exhausted at this point. Interest rates are getting low. The Fed has stimulated in enough cash at the moment. It may start injecting more cash, implement really what it might officially call QE4, right? And, you know, again, there's going to be a lot of things that are required in order to stimulate stocks, because especially in the United States, we've been living off of the stock buyback craze due to strong corporate earnings. If corporate earnings fall flat on their face and we can only get stock buybacks down at, say, 400 or 300 billion, right? It's going to be similar to what happened back here in 2007 leading into 2008. The stimulus stops, the punch bowl tips over, and the party's over. Like that's the general gist, guys, right? It's not crazy. We've talked about it for a long time, guys. It's inflows and outflows, right? So again, this is a major point to drive here, guys. Now, if we take a look here at Treasury Markets, this gives us a good indication as to what people are reading about what the Fed is going to do in the current state of the market. Similar to equities, we're seeing yields drop right back down and curve over. We take a look at the hourly here again. We're not seeing the same kind of growth we saw yesterday. We've stagnated base at a baseline here back to where we were back on the 6th of March on a lot of the Treasury yields. So the 1 year still down here at, for example, 0.39%. The 2-year yield still down at 0.455%, still keeping in that general range. You'll see a general trend here across the board. 50% still for the 3-year, and then also 0.668% for the 10-year yield. Okay. Now, I want to make it very clear, guys, as we've talked about on the channel, we've been discussing this topic time and time again, and even though it seems boring, it's a highly relevant topic for you guys. Yes, the bonds, the underlying price of these bonds are going through the roof, right? If you take a look at some of the broad ETFs like TLT, for example, that keeps up with 20-year treasuries, right, they're still holding up relatively high. The really scary thing here, though, right, is that yields are dropping down to negative territory, right? For example, the 10-year bond, right? Just use this as an example, right? I don't know if we can get the US 10-year. Actually, I know how to type it now. For example, US 10. There we go. So we can see here, for example, the 10-year bond. This is one of many of the treasury notes that you can get, right? They're still holding up nicely, right? It's not just the 20-year, it's the broader space. The question here is whether or not we're going to see them go high enough, right, to where these yields start going negative and they start being a hinder on people's portfolios, people's retirement accounts. Because when these start going negative, it's an obligation to hold these in your portfolio. You can say, and investors will say for a while, you know, especially traders, oh, but, you know, bond markets are going up, bonds are doing great. You know, for example, even though they're going negative, the principal value, right, the underlying value of the bonds are doing great, right? So what's to worry about, right? If I'm making this great amount of money in the short term, why do I have to worry about some small negative yield? Let's say it even goes down to negative 1%. If the bond's going up 10% in the year, what's the problem? It's because eventually that stops lasting. Eventually the gig is up. It starts hitting enough people where in their retirement accounts, their entire yield of their portfolio starts getting diminished by the negative rates. This cannot persist forever, guys. Plain and simple. And when the United States gets to this point where treasuries start going negative, the safe haven asset, the guaranteed income that people use in formulas like the Sharper ratio, like when that goes negative, I mean, this is going to be really scary, guys. That's what I'm concerned about. And I'm really concerned in the sense that we're not seeing a complete rebound right away off of this sharp sell-off. most of this should not be materialized, and it should be made up very quickly. But we're not seeing that here, right? Maybe I'm having a bit of a rush in all of this. Maybe I should be a little more patient, and I'm open to keeping open to the idea that I might be a little bit impatient on this, guys. But what seems like a simple chart could not be more important. That's the point I want to stress. And it just surprises me that we're seeing this in Treasury yields. It signals to me that markets don't have confidence in the Fed's response. The current CME group betting basically are the target projections for probabilities on where the interest rate for the Fed funds rate is going to be. Doesn't give me confidence. And how current markets are reacting across the globe does not have me sitting confident. Right? So this is my point here, guys. I'm not here to spread FUD. I'm not here to spread FOMO into, for per se, cryptocurrencies, for example. Crypto may not do good in this environment initially, guys. I think we've seen a little bit of a pullback here, relatively similar to equity markets. But I think the environment is going to dramatically change. I will say, I think it's going to dramatically change when the halving comes, right? Too many people either don't understand the halving event for Bitcoin, and along with that as well, are focused way too much on traditional markets. Bitcoin is still small. You're talking about a $144 billion asset, right? So if you're talking about the next 3 to 5 years and where your odds are for growth, you've got a multi-trillion-dollar asset class, which is equities, a multi-trillion-dollar asset class, which is properties, and an already $10 trillion asset class, which is gold. And then you got Bitcoin at $144 billion. You know, what market do you think has the ability to 5x over the next year? Or next 2 years, or 10x, or 20x. Again, just roughly thinking, what would be easier? What asset would it be easier for to be able to reach those multiples in your investment? I'm not saying that Bitcoin's doing that. I'm saying that out of those options, I would put my bets on Bitcoin personally. That's just me, right? So anyways, that's my key point, guys. Oh, a few key points, I guess. And if you guys enjoyed the video, again, drop a like. I appreciate it as always. I like hearing your feedback. If you agree or disagree, guys, leave a comment down below. You know, be kind, be knowledgeable about it and stuff. Try to share as much knowledge and data as you have. I try to do that here on the channel. Try to back up my claims here. But again, guys, there's a lot of interesting things going on now. No matter what, whether good or for bad, it is definitely an interesting time to be studying financial markets. And I wouldn't want to be doing anything else other than being here talking to you guys about it. So again, thank you all so much for your continued support here on the channel, and I'll see you all in the next video. Stay tuned.